From March 2012 to April 2021, the inflation rate was remarkably restrained, never once rising above the modest peak of 2.7%. But starting in May of that year, the inflation rate began to rise at a pace that we had not seen since the 70s. Everything you know and love began to get more expensive as the value of the dollar began diminishing rapidly. Often called the silent tax, inflation began quickly eating away at everyone, disproportionately affecting those at lower income levels. From February 2021 to June 2021, the CPI released by the government jumped from 1.7% to 9.1%. It's no coincidence that at the same exact time, a typical home in the United States had jumped from $284,000 to $344,000, an increase of 21%. I'm sure if you compare the price of almost anything during that same period, including McDonald's, groceries, and insurance, you'll find similar results. So why am I talking about this? Well, as you're about to see, this problem may have never really gone away, and very soon we might be dealing with a crisis related to exactly this. But to understand, we first need to take a step back and realize the power of something called the compounding effect. When we discuss inflation, we often refer to it in terms of a percentage. For example, if I mention that the Consumer Price Index hit nearly 9% in 2022, it implies that the average cost of goods and services in the US increased by about 9% during that year. While that sounds concerning, you might think a rise from $1 to $1.09 isn't cause for widespread alarm. It's a pinch, but not a catastrophe for the economy. However, the real issue emerges when we consider the long-term effects of inflation. Even a 1% increase can have a substantial impact over a decade. Now, this is the perfect example of what this means. We know that houses over the very long term essentially follow the rate of inflation, so their prices tend to align themselves with the inflation rate. That hasn't been true recently, but for the sake of this example, let's start with that. From 2011 to 2020, a time period lasting exactly 10 years, the inflation rate averaged 1.73%, which is actually below the target of the Federal Reserve, who sets the goal to be 2%. Now, if a house in 2011 was valued at $200,000, 10 years later in 2020, following the inflation rate only, that house would be worth $237,000. This basically means that the dollar you hold in your hand had lost around 16% of its value over that decade. To illustrate how even a slight difference can lead to a significant impact over time, let's consider a scenario. Imagine that from 2021 to 2030, a span equal to the earlier example, the average inflation rate is 4.3%. If a house is valued at $200,000 in 2020, by 2030, its worth could climb to around $350,000. This means that the dollar would have lost 34% of its value. And remember, these aren't drastic numbers. We're talking about an average of just 4% inflation, yet it results in a doubling of the rate at which the dollar's purchasing power erodes. This is also why the Federal Reserve is very concerned about keeping inflation down. But there is a whole faction of economists that don't really care. They claim that inflation isn't as bad as we're making it out to be, and the reasons they say that might not be aligned with the interests of the general public. I'll explain in a bit, but first take a listen to Nobel Peace Prize winner Joseph Stiglitz explain exactly this. Remember, this is a guy who's at the very top of his field, and what he says about inflation will probably shock you, I think.
When you get to a fork, take it, I think they say.
Let me explain why a little higher inflation overall would actually be good for the economy. Because what we've observed for a long time, is what we call downward rigidities. Right. Very hard to get wages to fall.
Right.
And when you're an economy going through, big structural change like we're going through, AI, the green transition, then you need to move labor, capital from one place to another. What guides that movement is changes in the relative prices. And when you can have more movement in that relative prices, which you can do with downward rigidity if you have a little bit higher inflation target, gives you a better ability to move resources without high unemployment.
As we've discussed, some, like Joseph, might not see the downside to slightly higher inflation. However, recall from the example before, for everyday folks, the gap between 2% and 4% inflation over something like a decade is quite substantial. The issue is many academics and government officials tend to favor a narrative that downplays the impact of inflation. It's quite straightforward. Back in 2002, we experienced the dot-com bubble burst, a rare moment when the Federal Reserve dramatically reduced interest rates to just about 1%. Many believe this action was a key factor in fueling the housing bubble. Recall that housing prices surged in the years leading up to 2007, timing that coincides with the Federal Reserve's decision. When the next bubble burst, the Federal Reserve responded similarly to its 2002 action, slashing rates nearly to zero. Every time the Federal Reserve attempts to fix the situation, what they're really doing is masking the pain that needs to happen in order for the root cause to go away. A deep recession oftentimes is the long-term solution for many of the problems plaguing markets. We need pain in order for new healthy growth to appear. Think of it as a naturally induced forest fire. But instead of allowing this, the Federal Reserve attempts to essentially artificially prevent any recessions from taking place, and they do so with this extreme action in interest rates. A 0% rate is what allows inflation to flourish and new bubbles to build. You see, right now we have rates rising higher and higher, but if for some reason there was a massive issue in the markets, you can bet that there would be a lot of political pressure to reduce rates even if inflation readings were high. This is because, from the government's perspective, it's a lot easier to inflate the pain away. What this means is that their debts become easier to pay as the dollar loses its value. Let's pretend you are the government and you owe $500 billion. Declaring a default and ruining your reputation and economy, or just printing the $500 billion and devaluing the dollar. It's obviously going to be the latter, because the U.S. is in a unique situation where most of the debt it owes is payable in the currency it produces. It essentially guarantees that the government will always choose to print. But the real issue with that is that it's paid for by the people via the silent tax, aka inflation. You can hear Peter Schiff explain this a lot better than me from this recent clip from the PBD podcast. He goes over both scenarios in detail. It's a bit of a long-winded answer, but I think it's worth your time. Take a listen.
What does that outcome look like to the average person that's listening? What would that more devastating outlook look like? We saw in 08-09, the market crashed, housing prices went down, unemployment skyrocketed. Those are the things that people can see, feel, and touch. When you say more devastating outcome than 08, what does that look like?
We have to appreciate the fact that really, in earnest, it started in 2001, 2002, after the dot-com bubble burst, right? That's when the Fed first lowered rates to 1%. I mean, Greenspan made a lot of policy errors in the 90s as well, and that's kind of why the stock market bubble got as big as it did. But the policies really, went to, the sublime in 01 and 02 with the rate cuts that gave way to the housing bubble, which led to the 08 financial crisis. But every time the Fed creates a misallocation of resources, malinvestment bubble, every time it pops, instead of allowing the market to fully correct for all the mistakes that were made in the past, right? The recession, as far as the business cycle goes, this boom-bust cycle, the boom is where the mistakes are made. The bust is where they get corrected. And you have to allow the market to do its job. But in the short run, that's painful because people lose their jobs, they lose money, and the voters don't like that. So there's always political pressure on the government, the Fed, to try to fight a recession when the recession is the cure. So fighting it simply makes the disease worse. But what they do is they keep creating more inflation, and it's kicking the can down the road and postponing the inevitable pain. But every time they do that, they make the underlying problem worse, and therefore the ultimate pain to resolve it, right, worse. And so my point is we are now at the final, crossroads where the Fed has to pick the lesser of two evils, right? So on the one hand, it can fight the inflation that it created, with QE and all this, the expansion of its balance sheet. It can fight the inflation. But to do that means interest rates have to go much higher than they already are. They have to go high enough to force massive cuts in spending on the government level and on the household level. But our whole economy is based on spending right now. It's a bubble. And so they have to create a massive recession. It's not that recessions are necessary to fight inflation. It's just that what's necessary to fight inflation will also cause a recession because of the underlying nature of the economy. And This recession, which will have a housing market crash, a stock market crash, will result in a wave of defaults and failures. There can't be any bailouts like we did in '08. So when a bank fails, they can't bail it out. They have to let it fail. And they have to allow the depositors to lose money. There's no money to bail out the depositors. They have to lose. The government has to tell people on Social Security and Medicare, we just don't have the money to make the payments. We're not talking about making cuts for people in the future. The checks we're sending out right now, we don't have enough money. We gotta make those smaller. Right? Social Security, the trust funds, so-called trust funds, are already selling treasuries right now. Social Security already takes in less than it puts out. It's insolvent. So the government has to tell government pensioners, we can't make the pensions because we're broke. We actually have about a $3 trillion a year deficit right now, maybe closer to 4. I mean, even if they massively increase taxes on the middle class, I don't think there's enough they could do it.
So, as you just heard there, the final summary is that the government would rather watch prices rise and print away its problems rather than suffer a Great Depression. So this is it for today's video. See you again next week with another video.